Welcome back to another video of Dxpert. I'm one of the researchers, Jean, and today we'll be talking about the Japanese yen again as a continuation of last week. I know I've talked about the dollar-yen pair several times, but it's because the Japanese yen has been so volatile. Just look at the price changes over the course of 4 days. As mentioned last week, the dollar-yen crept up to the 160 level, which triggered an alleged yen intervention, bringing back the price level to around 155. However, that wasn't just it. As the price slowly drifted upwards again to 158, the dollar sold off heavily, which dropped 1% in a matter of minutes. Hence, Japanese authorities didn't intervene just once but twice in 4 days. It was reported that Japanese officials may have spent 3.66 trillion yen, which is equivalent to $23.59 billion on their most recent intervention, and around 6 trillion yen on April the 29th. If you're thinking, wow, that's a huge sum of money. Yeah, it is, but the question is, will it make a difference at all? According to analysts, it did indeed bought some time to prop up the frail yen, but the market still views the currency as a sell. According to CFTC's COT report, it showed that non-commercial traders, aka speculative traders, reducing their yen short positions to around 168.4 thousand futures contracts in the week ended April 30th, still close to their largest bearish positions since 2007. So there is only a small reduction, signaling that those who are long USD-Japanese yen pair didn't seem to have been too intimidated by the Japan's Ministry of Finance and the Bank of Japan's FX interventions. However, it currently makes it harder for yen bears to bet against the yen. Just like what happened back in 2022, Japan intervened a total of 3 times its September and October of 2022, spending roughly 9.2 trillion yen, which is equivalent to $58.7 billion at current rates. Though this time the interventions have not prompted a sustained rally, but it has made the yen more volatile, making it harder for investors to hold large bets against it. Interventions can occur even beyond trading hours or during holidays in Japan. Therefore, it makes it almost unpredictable, just like what Lorenzo Di Mattia, a chief investment officer at Sibilia Capital, has stated. If you're short, you're against the intervention and lose when it happens. On the other hand, if you're long, you're betting on an intervention, but at which level will it come? Meanwhile, US weaker than expected April jobs report revived hopes for a sooner rate cut, with overnight swap markets now expecting a rate cut in September rather than December, as the economy not only created fewer than expected jobs last month, but wage growth also slowed. But if we look at the bright side, HSBC projected that the weakness in the yen will play a key role in reflating the economy, a goal that the BOJ expects to achieve this year, well, as long as the decline is orderly. So a weak yen doesn't necessarily mean a bad thing. For example, tourism. It's the main booster for the service sector in Japan. It will in turn help lift inflation. In 2023, spending by visitors totaled a record of 5.3 trillion Japanese yen, improving its GDP. Another factor is exporters' profits, making their products cheaper to buyers overseas. Now, to wrap this up, I don't see the yen to strengthen in the short term. Japanese authorities can only do 2 things. Firstly, buy up the yen, which they have done but it doesn't seem effective. Or raise interest rates, which is not likely for now. So if you're trading the dollar-yen pair, do expect volatility in the upcoming months. Subscribe, like, and share this video if you enjoyed it. See you in the next one.